This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the first chapter in a series of chapters regarding corporation tax, which is the main tax that companies have to pay. I would, as before, suggest that you watch these in the order in which they are in the manual, on the grounds that each chapter builds on the next one. And to watch them out of order would prove to be a little bit difficult to understand, because there is assumed knowledge from one chapter to the next. So please watch them in the correct order. So, corporation tax. If they are resident in the UK, they are chargeable to corporation tax on their worldwide income and gains. UK companies are. Now, is a company UK resident or not? This and the following ones, typical multiple choice kind of questions that you could get in section A. So, a company is resident in the UK if it's incorporated here. Okay, if it's incorporated, and you'll be able to tell. Or it is centrally managed and controlled from the UK. So you may see one that says Inc. That means it's incorporated overseas, but the majority of the directors resident in the UK, and that's where the board meetings are being held. So just read the question carefully, but this again could be a multiple choice question. Could you define what is a UK resident company? Some more definitions, and again, these are more likely to be multiple choice questions section A than anywhere else, because there is no maths involved. So a period of account, you can see that as a multiple choice question. What is a period of account? And then there'll be 4 to choose from. In a multiple choice situation, try and answer the question first and then make sure that your answer is one of the 4 that you can choose from, rather than looking at the 4 and then getting confused because you're not sure which one is which. Your knowledge level should be such that you can actually choose which one because you've already answered the question in your head. So a period of account is a period for which the company prepares its accounts. Now it's usually 12 months long, but it may be shorter or longer. It usually starts when the company starts to trade, and it ends when the company has reached 12 months or they cease to trade. Now, corporation tax is chargeable on accounting periods. So a company's accounting period, normally the same as its period of account, but, and there is a but to this rule, this is the but to the rule. If the accounting period is excessive and more than 12 months, then 2 corporation tax computations are needed. The first will always be 12 months and the second will be the remainder of the period, in which case there are 2 accounting periods. So when do these accounting periods start and end? You can see too that this is multiple choice question, section A questions. So it starts immediately after the previous one. So they obviously follow on from one. So if their year end is the 31st of December, then the next accounting period starts on the 1st of January. It will start when you start to trade and you become liable to corporation tax if it's your first set of accounts that you're preparing. Now it ends normally 12 months after, but it can also come when the company ceases to trade, as I've mentioned before. Now, companies pay their corporation tax based on the rate that is currently in force due to the Finance Act when those accounts take place. So all the financial years, it runs from the 1st of April to the 31st of March. That's different to the income tax year, which runs from the 6th of April to the 5th of March. So the financial year 2022, which is the one that we will be dealing with in this exam, runs from the 1st of April 22 to the 31st of March 23. And the corporation tax rate has remained static at 19%. That makes working out the tax for companies very, very simple, because it's basically 19% all the way through. Okay, again, more multiple choice questions in section A. Along with the admin, there is an admin chapter for companies. There are no lectures for the admin chapter for the companies. Therefore, you need to be able to work that one out. Read that one for yourself. So it usually pays your corporation tax 9 months and 1 day after the end of its accounting periods. Large companies, they have to pay by quarterly instalment payments. So now, what is a large company then, you ask yourself? So profits exceed 1.5 million. Now, profits are defined as, this is the total taxable profits plus the dividends received, excluding dividends from group companies. All that will make sense as we get further on. Companies are related 51% group companies, where one company controls another or two or more companies. Do not include a dormant company if you are working this out. Okay, so group companies, this is the definition of one of those. Now, if there is a group and there are more than one in that corporation tax group, then the limit will be divided between the members of the group. So that 1.5 million profits that I mentioned further up the page is for a single company only with a 12-month accounting period. So it's prorated if it's a small accounting period. Okay, so that's one company for 12 months accounting period. If it's more than one company, you divide it up. If it's less than 12 months, you divide it. If there are a group, you divide it between the number of related group companies and time apportion the accounting period if it's less than 12 months. So we have an illustration here. So Large Limited prepares its accounts to the 31st of March each year, and for that accounting year ended 31st of March 2023, it had TTP of 600,000. Also received dividends from a number of companies, including its 2 wholly owned subsidiary companies. So Large has 2 companies, we'll name them A and B for this point, this illustration. Wholly owned, 100%, A and B. So how many are there in the group? There are 3 of them. Now, it also received dividends from a number of companies, including 2 wholly owned subsidiaries. This was the lowest profit recorded in several years. So that's the question in effect, and this is the answer. As Large Limited has 2 subsidiary companies, there are 3 related 51% group companies, which will reduce the limit, so each of them £500,000. As Large has a TTP of 600,000, then without including any dividends, its profits exceed the limit, and it will therefore be required to make quarterly payments to settle its corporation tax liability. So all this is about when do they pay their tax. Normally they pay 9 months and 1 day. If it's large, 1.5 million more profits, then they pay by quarterly instalments, and then there's the extras, the bits on top, the buts to the rule. If there are more than one company, you have to divide that limit up, and then you pay by quarterly instalments if you're over the limit. Alternatively, if it's a short accounting period, then you will also have to prorate that 1.5 million. Now, we've mentioned so far TTP, taxable total profits. So a company's corporation tax liability for an accounting period is calculated by computing, do you remember that word, or working out its profits, including gains, because it doesn't pay capital gains tax, doesn't pay that. It pays corporation tax on those gains from all sources, deducting qualifying charitable donations. This figure is known as TTP and is charged at a rate of 19%. So we have a lovely pro forma here. I'm getting to like these pro formas. This is what the model answer will look like in front of the marker of your exam. Please make sure that yours looks like this. Okay, so we have trading income, adjusted profits and capital allowances. Now the main rules for this, there are one or two differences which we're going to look at, but the main rules for that are in the individual chapters, which if you've read your manual and watched the lectures in order, you'll have done that. So this is a bit of a recap for those of you who've done that. Capital allowances come off the adjusted profit, and that goes in there. Now then we have other income and gains, interest receivable, property income and net chargeable gains. So that's the gains in the year, in the accounting period, minus any losses in the accounting period. And again, all the gains information, the main rules, you'll find in the CGT chapters. Slightly different in some areas, but we're going to deal with those again as we go through these corporation tax chapters. But the main rules are very similar. All of them are added together for total profits. Then we take off qualifying charitable donations. You'll hear me call them QCDs. They're deducted and that gives us our TTP. Now we've got a couple of notes that go with this. Dividends received from other UK and overseas companies are not taxable. Okay, dividends paid are not deductible. They do not appear in this computation. So royalties payable. Now these are much rarer than they used to be. A royalty is, so if you write a book, then you will have that with your name on it. Anybody uses that, they have to pay you a royalty. If you make a record, it becomes very famous. Every time somebody plays your record, your music, they have to pay you a royalty. If you're an actor in a film, every time they show the film, they have to pay you a royalty. So also things like designs. If you make pottery and you've designed a plate for the company, and they produce that plate, every time they produce that plate with your design on it, then they have to pay you a royalty. So that would be an allowable expense. So royalties are allowed as a deduction when calculating the adjusted profits. The taxation of royalties receivable will follow the accounting period treatment on an accruals basis. No adjustment needed. So basically, if you see a royalty, ignore it. Make a note at the bottom that that's what you have done.